Well, it has been an interesting weekend, and it just keeps getting better and better moment by moment. So let's start out with this. It's from TB, and he goes by it's TMANN on X. He says, "What did I tell you, Randy?" And then he's referring to this from Tesla Newswire. Now, Tesla Newswire is not a Tesla affiliated company of any kind. It's just another X participant. Anyway, Tesla upgraded Model Y Juniper prototype has been spotted for the first time. Okay. So that's what TB is trying to say, is that he's been trying to tell me we beginning to see these sightings. So when the sightings are happening about 6 months out from the beginning of the year, which is when I believe Elon had said that's when we'd be looking at the Juniper coming out. So that's extremely exciting news, and I'm very excited to be able to tell you that, except Elon wants me to shut up. Well, not me specifically. He wants all of us to please be quiet. There's not going to be a Juniper in 2024. He's very specific and explicit about that. Well, that's what we expected anyway. We expected it in 2025. But he says if we start talking about it and yakking about it, it's going to Osborne the Model Ys that he needs to sell over the next 6 months. Yeah, I get that, Elon, and I want to be all that I can be for you and for Tesla, but I also have an obligation to my troops, you guys, and I figured, you won't tell, right? I mean, we'll just keep this between us. Anyway, so Elon doesn't want us to talk about it, but you were going to see it. Believe me, you were going to see it. So I felt I really, really needed to talk about it. I'll probably talk about this a little more with Brian, and also we're going to definitely be talking about this new patent for an automated interior cleaning device of some kind for for cars. Not exactly sure exactly how it works or anything. Didn't spend any time at all kind of looking into it. I'm hoping Brian's going to be able to really let us know tomorrow exactly what's going on. Because imagine if you don't have to, don't have to clean the cars every day on the interior. Maybe the exterior is going to be very, very easy to clean, or maybe it won't be necessary to clean it. I don't know how all that's going to work, but if the interiors don't need to be cleaned as often or as thoroughly, that would be a huge help to the new robotaxi business. Whether or not this will be something that will be available on all cars or only on the specific, robotaxi or the cybercab type vehicles, I don't know, but we'll find out more maybe on 8/8. But again, Brian and I will dig into the patent, I think tomorrow. That's what the plan is. Okay, then this is something apparently we're okay to talk about. The semi plant in Reno. I put out a short video on this earlier. Again, I'm not going to go into a lot of detail right now. We just know that they've delivered a lot of steel. And so that means what? That means they're ready to start actually putting up some steel, putting in some whatever they're going to do. I don't know. I watched these buildings go up around here on Riverside. We are the distribution center, the capital of the world here in the Inland Empire, and they can put these things up so fast. Now, I don't know that's going to be the case or not. We'll find out with regard to what's going to happen in Reno, but great to hear that that is on the way. So those two catalysts, the automated interior cleaning device, the semi plant in Reno, and probably some people that are going to not be able to ignore the fact that there's been a Juniper sighted in the wild. Those three things together, plus the momentum, thinking tomorrow's probably going to be up, but hey, that's not investment advice. It's like, you never know what could happen between now and tomorrow morning. And it could be down tomorrow, but I would say the odds are we're going to test 260 sometime this week. If we go jumping past 260, 265, we get much ahead of that territory. We're going to 300. Probably. That'd be my best guess. All right. This is from Sawyer Merritt. He says the hedge funds piled into short bets against Tesla right before the delivery numbers were announced. And they lost big. 18% of the 500 hedge funds tracked by Hazel Tree had an overall short position on Tesla at the end of June. That is the highest percentage in over a year, and they lost their shorts. Okay, this is Randy Kirk. And please hit like and subscribe and notify. Of course, notify because tomorrow is a regular day where we have After the Bell, followed by Brian White, followed by Larry Goldberg. How much better does it get than that? And then we would also like you to join Patreon. First of all, we had Mr. MC joining today. Thank you very much. We have Zed over on X. I now have, he or somebody else told me I really needed to set up a subscription and a tip jar or something. Anyway, I'm trying to do all that stuff. Well, Zed, decided he wanted to be number one, the very first to send me some Bitcoin through X. And so he sent me $10 worth of Bitcoin. And thank you, Zed, for that. He wants me to hold it for 10 years. Do you know how old I'm going to be, Zed? 10 years from now, I won't be able to walk. I'll have to spend my winnings. If it's worth $1,000 or $100,000 by that time, I'll have to use it to buy, a walker or something. Anyway, but anyway, I now have my first stake in Bitcoin, the first Bitcoin I've ever owned. How about that? Now I don't know what to do. Maybe more people will send me tips on X, and I'll start to amass a huge fortune of Bitcoin. We'll see. All right, Gary W. increased his membership from $3 to $5. Then he jumped once again, same day, got very generous and decided to go all the way to Plaid. So thank you, Gary, for going all the way to the $50 a month. Very kind, very kind. Okay, earnings start this week with the banks and with Delta Airlines, also as one of the big majors that we'll be reporting this week. Not too many other majors this week. And then, of course, next week it gets serious. And then the following week after that will be Tesla and other lots and lots and lots of serious players, lots of the tech companies in that third week of the month. So Kobasi says there's more evidence of a slowing U.S. economy. The U.S. services activity contracted in June at the fastest pace since the 2020 pandemic. The ISM Services PMI index fell by 5 points to 48.8, missing expectations of 52.5. So 50, of course, is in balance. And so if it was above, it means expansion. If it's below, it means contraction. He says this was primarily driven by an 11.6-point decline in business activity index, lowest level since April of 2020. In the past 30 years, such a service activity drop happened only during recessions. Furthermore, new orders shrunk for the first time since 2022. He says his conclusion, data is getting weaker. So with that in mind, this is from Fortune magazine. Fortune says, get ready for a bonanza of rate cuts from the Federal Reserve that starts in a few months and extends all the way into next summer, according to analysts at Citibank Research. In a note on Friday, the bank cited fresh signs of a slowing economy for its view that the Fed will trim rates by 25 basis points 8 times, starting in September at every single meeting and going all the way to July. That will lower the benchmark rate by a whopping 200 basis points from 5. Were you able to do the multiplication? I know you probably didn't. They probably didn't have to do that for you, right? Anyway, or from 5.25 to 5.5 now to 3.25 to 3.5 later, where they will remain for the rest of 25. That's what they're suggesting might happen. Well, we remember how everybody's a speculation as to what would happen with the Fed rate cuts earlier this year. Turned out to be a little muddy. But Randy, as a clock, a broken clock, gets it right twice a day. I have gotten this one right so far this year, saying no, none, zero zip cuts in the Fed rate. They're now suggesting the first one will come in September. That is what the betting is right now, and that there'll be another one in November. I'm still thinking it's going to be the first one in November. I'm hesitating, as you'll see, as you continue to listen to tonight, probably as you listen to more with with Larry tomorrow night. We'll see what Kathy has to say. She did not have her show. They were on vacation this last Friday, so they didn't do the show as normal. And so Larry and I got up early and kept looking for it. Anyway, next Friday, they'll be doing it. Saturday morning, Larry and I will cover it. I'm beginning to think, well, I've already told you, I think 100% GDP will be down in the third quarter if it isn't already down in the second quarter. They go on to say the economy has cooled off from its heady pace in 2023 with inflation resuming its slowdown after the stickiness earlier this year. This is according to Citi analysts led by chief economist Andrew Hollenhorst. But the Institute for Supply Management, they bring up the same thing that Carbasi just was talking about. They are worried about that particular one too, because again, the services industry is holding everything together. Okay, we've already talked about this. Housing's down in recession. Transportation has been in recession. Housing has been in recession. You've got everything's in recession except for the government now. If services go into recession. A continuing softening of activity will provoke cuts at each of the subsequent 7 Fed meetings after starting in September. The note also pointed to other signs of weakness in the jobs report. We already been through this. There was 206,000. That sounds like a wonderful number, except they lopped off 100,000, more than 100,000 for the prior 2 reports. And my guess would be that the 206 next month, they'll lop off another 50,000 from that and 50,000 from the previous May report for, and maybe next month we won't even have an increase, or it'll be 40 or 50,000 up. Anyway, June saw a decline of 49,000 temporary service jobs. This is the kind of thing that Citi says that you typically see when you're going to get a decline. Now, I've got an opinion on those temporary jobs. I'm going to wait till next Friday when Kathy and Larry and I can talk about that. I think most of you already know my feeling about the temporary job situation is very, well, let me just really briefly tell you, these companies are holding on to employees that they normally would have let go already. Okay? They're holding on to them because their profits are okay. And so they're holding on to these employees because they were afraid to let them go. And so they don't need temps. It's a very different circumstance. It's all part of the boom bust cycle. This boom bust was extreme. And right now, that's what I believe is happening. We'll talk about this again. I'm sure we'll be talking about it again next Saturday morning. Payroll data are also likely skewed to the upside, leaving the unemployment rate, which is derived from a separate survey, as the more important metric. And on that front, Citi pointed to the SAM rule, which I talk about all the time on this channel. It said it could be triggered in August if unemployment continues to rise at its current pace. So if next month we get from 4.1 to 4.2, that would be the SAM indicator would now be 100%. Right now, it's only done 5 months in a row. The SAM report thing needs, I think, 6. It could be 4 and 5. I can't quite remember. Hollenhorst has been relative contrarian this year by maintaining a dimmer view of the economy, even as Wall Street consensus shifted to a soft landing. As you know, I was of an opinion that maybe we would get through without a recession. Then starting about late February, early March, I said, no, I think we've got about a 30% chance of having a recession in the third quarter. And then just this last week, I was there, then I was there. And now I'm 100%. I just feel it's 100% third quarter recession. Maybe now. We may already have a lower GDP now, or as who was it that said the other day? Yeah, except that they'll say the first report that comes out now will say that it was up 1.2 or something. And then next month we'll find out it wasn't. And then next month will be even lower. That's how it's going to work. In May, he doubled down on his warning that the U.S. is headed for a hard landing and that the Fed rate cuts won't be enough to prevent it. That followed a similar forecast in February, even amid blowout jobs reports. Remember, jobs typically were down after the recession starts. Yeah, keep that in mind. In an interview with Bloomberg on Wednesday, Hollenhorst noted that the sharp recession would likely produce enough political consensus for more government spending. No, that sounds like something Bloomberg would say. That's the last thing we're going to need. We just need to have the recession. Get through with it and move on. We do not need the government to spend more. But a more mild recession may not result in such a consensus, he says. He also pointed out that the Fed rate hikes slowed the economy less than anticipated. rate cuts have not stimulated as much. In addition, 10-year bond yields, which serve as a benchmark for a wide range of borrowing costs, are already below 2-year yields, leaving less room for further downside, especially as rising deficits and inflation add upward pressure. This has been the problem all along. I've been saying forever, what nobody pays any attention to me on this is that 5% interest rates are not abnormal. 6.8% mortgages are not abnormal. 7.5% car loans are not abnormal. This is normal. And people get used to it. They can adjust to that. What they can't adjust to is that they got used to spending all that free government money, and now they don't have any more. And so the lower half of the public, people making less than $100,000 a year, they're in trouble. They're the least likely people to be able to figure out how to adjust. Finally, this article finally says most economic activity is going to be more responsive to a 5-year yield and the 10-year yield. It's not really about the overnight policy rate. So there really are questions about how much can you transmit that stimulative effect of lower policy rates. No, yes, it will have an effect. It'll be 3, 4, 5 months after they start lowering rates. It will trickle down because guess what? The 10-year and the 5-year yields will come down as well. Anyway, Market Watch has this adding on to the story. Wall Street for now expects S&P 500 companies overall to put up earnings per share growth of 8.8%, an increase, okay, of 8.8%. I think that is year over year. If that number sticks, it would be the biggest gain since the 9.4 increase in the first quarter of 2022. Now this is different. Now this is the profits of the corporations. This is not the same as the overall economy. Now it matters because that's one of the ways that we get to the productivity numbers, but it's not really going to help the economy if there's no sales. Profit margins are expected to come in at 12% for companies in the index. Some economists over the past few years have suspected that companies have kept prices high to fatten those margins despite consumer struggles to keep up. That only works so long. Of course you do. Of course, that's exactly what every company does. You want to keep your prices as high as you can, as long as you can. But if all of a sudden your sales are flatlining, then you've got to do something. You either have to change the product, you have to redesign it, make it something, add it together with something else. You know, I always refer to it as make it upside down, turn black to white, inside out. In other words, what can you do to make the product appear to be worth more? Or you have to lower the price, or you have to find a way to cut the costs and then lower the price. Profit margins are expected to come, said that already. These gains boiled down in part to easier comparisons against last year as cost cuts filter through to the bottom line. But as with previous quarters, they'll be driven by a handful of massive technology companies as well, whose stock prices and bottom lines have also benefited from artificial intelligence hype. Well, I wouldn't call it hype. I would say they're actually doing something. Taken together, the results from the JP Morgan, they will offer an early look at the economy overall after a big rally for big bank stocks, because the banks will do very well this week, and the broader market through the year. But that run higher could make investors less forgiving if the companies miss quarterly expectations during the next quarter. But what's also going to happen, again, we have to always look at what are they saying in their go forward? What are they saying about the next quarter? What are they saying about sales coming up? That's going to be the key. Wall Street Journal says this is about lithium and lithium mining. Instead of cutting back on lithium output to balance easing demand growth, miners have sought to ride out the downturn by slashing costs and putting off new projects. This week, a closely followed lithium price from Benchmark Mineral Intelligence sank to its lowest level since the market data company began publishing weekly prices in 2023. That price for Asia spot lithium carbonate fell to $12,500 a metric ton, down 3.8% from a week earlier. A year ago, it was $43,000 a ton compared to $12,500 now, which at the time looked like a bargain to some versus January 2023 when it was $76,000 a ton. So we were at 76,000 a ton at the top when you were paying a fortune for any electric car. Last year, it got down to $43,000 a ton from 76, and then now it's at 12,500. Do you see why some people think maybe Tesla will be getting some advantages on their bill of materials in terms of being able to buy batteries much cheaper or make batteries much less expensively? Other benchmark prices show that the market at around a 3-month low. All right, what's going to happen this week then? We got a whole bunch of stuff coming up this week. Let's take a look here. First of all, on Monday, we've got consumer credit. Last month, it was up 6.4 billion. This time, they're expecting it to be 8 billion. We would really like to see, last month, it was a good month. We saw the consumers did not increase their spending that much. This would be a little rougher and a little more of a problem in terms of the consumer running out of cash and relying more on credit. On Tuesday, one of my favorite reports, and one that should get way more attention than it does, is the National Federation of Independent Business, NFIB, Optimism Index. We will pay a lot of time and a lot of attention on that on Tuesday morning. Last month, it was at 90.5. They're expecting it to drop even lower to 90.3. That's not good. And the small business people last month were very, very, very negative, very negative. It was a horrible report. If that continues, it's, small business is 40% of the economy. On Wednesday, then on Tuesday, we also have Fed Chairman Powell testifying before the Senate, and that continues on for Tuesday and Wednesday. Nothing could go wrong in that. Well, actually, we might see some dovishness. That could be a positive thing. He can start to go, well, we're starting to see. Anyway, we'll see, especially because that NFIB optimism index will be coming out and the credit information the day before. We'll see. All right, Wednesday, we've got wholesale inventories, which were up 0.1% last month. They're expecting that to jump up 0.6. That would typically not be great. You don't want your wholesale inventories to be going up by 0.6% like that. It would indicate that you're not selling them through. Thursday, we get initial jobless claims. Of course, they were 238 last month. The folks are expecting 240. Again, the one that we follow the most carefully there, I don't know why they don't put it up on this list, is the one we should really be carrying, is the people that are staying unemployed, the folks that are out for more than a week. That's the one that really you have to pay attention to. Then we get the CPI on Thursday. Okay, so we'll be spending some time on that Thursday morning. Last month, it was 0.00. It was flat. This month, they're expecting to be up 1.1%. That would be fine. CPI year over year was 3.3 last month. They're expecting to be 3.1. I don't have any reason to question either one of those on the headline numbers. Let's see what the core is. Last month, it was up 0.2%. They're expecting that to be the case again. And then the year over year to be 3.4, both last month and again this month. So that would still be way, way, way too high. And the core is what they're going to be paying attention to. A lot of that core, of course, is rents. Auto insurance is a big problem. Some other categories. I think what we're really going to see, as I mentioned, I think this morning, I think you're going to start to see regular rents, apartment rents actually going up again. And that's going to be a real question going forward. Then we've got the St. Louis Fed President Alberto Musum speaking, Musalem. Anyway, he's speaking on Thursday. And then we get the U.S. federal budget. It was 228 billion negative. I'm not sure if this is reading correctly. I'm going to leave this alone. We'll just report it on Friday after we see what the final numbers are. Okay, then on Friday, we get the other one. We get the PPI. PPI last month was down 0.2%, expecting this month to bounce back up 0.1%. PPI year over year, no comment. So last month it was up 2.2%, which I'm sure the Fed would be thrilled if it stayed around there. Core PPI was also 0.00 last month. That was very good news to the Fed. But remember, the PPI is not necessarily, we've talked about this a lot on this channel, it does not necessarily presage what's going to happen at retail. There's too many things that happen between when the manufacturers buy raw materials, the wholesalers buy raw materials, and even the retailers get the stuff, and when they finally sell through. So you can have increases here that don't get passed through the retail. You can have decreases here that don't get passed through the retail. Anyway, so core PPI year over year last month was 3.2, way too high for the Fed. Consumer sentiment also comes in on Friday. That last month was a 68.2, a very poor reading, and 68.5 is what they're expecting this month, which would continue to be a poor reading. All right, let's take a look at what's happening with markets as we go into the new week. Let's start with the bonds. We've got the 10-year is up 1.9 basis points. You got the 2-year up 1.7 basis points. So now they've been tracking the last couple of days, and it's around 33 basis points between them. You've got the 2-month unchanged. So that is still sitting way out there at like 110 or so basis, 100, yeah, almost exactly 110 basis points difference. But the 2-year and the 10-year has shrunk down there to about 33 basis points, which is the low end, but it's not shrinking more. So we'll see what happens this week. Okay, we go over to oil. We've got oil is down a little bit on Texas Intermediate, up 0.22% on Brent. So there's a spreading out of that difference, although I've heard that things are pretty calm in the Middle East right now, so I'm not sure why that's spreading out, but it's not spreading out much. Natural gas down 0.47. Let's see, I read all about natural gas the other day, something about the hurricane affecting negatively on natural gas prices. That made no sense to me. Maybe the wet weather would keep the temperatures cooler in Texas, and therefore they would use less natural gas. I really couldn't make hide nor tail. I couldn't figure it out at all. If anybody knows why natural gas has been dropping this much, help me out here, because that article certainly didn't explain it. Gold down $3.10 for the day. I'm sorry, go in the pre-market here. Silver down 0.91%, back under $30 again. And copper at $4.65, $4.65, $4.66, up 0.08%. Then we go to Bitcoin. So I've already lost money. It's down $2,000 today, 55,861. So my $10 is only $9.97 now. Anyway, let's go here. We've got the dollar edging down because of the jobs data, I guess. That's what the headline says. I'm just going to read the headline there for you. And then equities. What we've got is all down. All the equities are down, almost exactly the same, 0.15% across the board. That would be the Dow down 56, S&P down 8, NASDAQ down 29.25 in the pre-market. Okay, so with all that said, remember to like, remember to subscribe, hit notify, and then join Patreon. That'd be wonderful. Or increase. If you're already a Patreon member, follow some of your friends, increase your donation. That'd be phenomenal. Or maybe if you're over on X, you would hit the tip jar. Then eventually, I guess I'm going to have subscriptions over there as well. So that may be a possibility. For some reason, I haven't been able to get that figured out yet, but we'll get that subscription thing going over there too. So thank you for all of that, all the contributions, all the help. But you know what? If all you do is watch, that's phenomenal. I appreciate just having you in the audience. It's been great talking to you.